It looked safe, it sounded professional, but it ended up destroying his finances. This is the story of how one seemingly smart investment cost a man almost everything he had worked for. Meet David, a 45-year-old software engineer, a husband, and a father of two. For years, David was the model of financial responsibility. He followed all the rules. He saved diligently, invested wisely in his 401k, and always paid his bills on time. He was building a secure future for his family, one careful step at a time. His life was comfortable, predictable, and most importantly, safe. But in the world of finance, the line between safety and disaster can be thinner than you think. David was about to learn this lesson the hard way. Let's rewind a bit to understand the man behind the story. David earned a solid six-figure income. He wasn't extravagant. He drove a reliable sedan, not a flashy sports car. His family lived in a modest suburban home, not a sprawling mansion. They took a nice family vacation once a year, usually to a national park. His biggest financial goal was to ensure his kids could go to college debt-free and that he and his wife could retire comfortably. He had a healthy emergency fund, a diversified portfolio of index funds, and almost no high-interest debt outside of his mortgage. He read financial blogs, listened to podcasts, and felt he had a good grasp on managing his money. He was the guy his friends went to for sensible financial advice. In his mind, he was doing everything right. One evening, while browsing a well-respected financial news website, David came across an article about a new investment opportunity. It wasn't a risky startup or a volatile cryptocurrency. It was a private credit fund managed by a firm with a long, impressive track record. It was positioned as a safer alternative to the stock market, with less volatility but a better return than a savings account or government bonds. It was the ideal place to park a significant portion of his cash savings. Money he had set aside for a future down payment on a larger home. He did his due diligence. He read the prospectus, researched the management team, and saw that the fund was praised by several financial analysts he respected. The minimum investment was substantial, but David had the funds. After discussing it with his wife, they decided it was a logical, low-risk move to grow their savings a little faster. He transferred $200,000, feeling confident and smart. For the first year, everything went exactly as planned. David received his quarterly statements showing steady growth. The promised 8% return was materializing right on schedule. He felt a sense of pride, a quiet satisfaction that his research had paid off. He was outsmarting the market, finding a safe harbor in a turbulent financial sea. He even mentioned it to a close friend who was impressed by David's sophisticated investment choice. The fund seemed like the golden ticket, the perfect blend of safety and growth. But beneath the surface of those glossy reports and reassuring numbers, a storm was gathering. The global economy was beginning to show signs of stress. Interest rates were rising, and whispers of a potential recession grew louder. David saw the news, but he wasn't worried. His investment was in a private credit fund, lending to stable businesses. It was insulated from the wild swings of the public markets, or so he thought. The first sign of trouble arrived as a simple email. It was a quarterly update from the fund managers. The tone was slightly different this time, less celebratory. It mentioned market headwinds and temporary valuation adjustments. The return for the quarter was slightly down. David brushed it off. A small dip was normal. Nothing to panic about. But then, the next email came. The fund was temporarily suspending redemptions. In plain English, he couldn't get his money out. The email explained it was a necessary measure to protect the fund's stability amidst market volatility. Panic began to set in. David tried to call his contact at the firm, but he could only reach a junior associate who read from a prepared script. The calm, professional facade was starting to crack. He scoured the internet for information. News articles started popping up. The stable, mid-sized companies the fund had lent to were struggling. Several had defaulted on their loans. The value of the fund's assets was plummeting. He couldn't believe it. How could this happen? He did everything right, didn't he? The numbers on his online portal, once a source of pride, were now a source of dread. 200,000 had become 150, then 100, then even less. Every refresh of the page was another gut punch. He felt sick. The money he had so carefully saved, the future he was building, was evaporating before his eyes. The financial fallout was devastating, but the personal consequences were even worse. The $200,000 wasn't just a number on a screen. It was their dream of a bigger home, a buffer for college tuition, a piece of their security. That security was now gone. The stress was immense. David had trouble sleeping. He was irritable and withdrawn. His wife, who had trusted his judgment completely, was now anxious and scared. The tension in their home was thick enough to cut with a knife. Arguments erupted over small things, but they were really about the massive loss looming over them. David was consumed by guilt and shame. How could he, the responsible one, have made such a catastrophic mistake? He had to tell his children that their planned summer trip was cancelled. Seeing their disappointment was another turn of the knife. He felt like a failure, not just as an investor, but as a husband and a father. The dream of a comfortable retirement felt impossibly distant. He was 45 years old, and it felt like he was back at square one. This story isn't about blaming David. He wasn't greedy or foolish. He was a regular person trying to make smart decisions for his family. He researched, he planned, and he trusted what appeared to be a professional, reputable firm. His story is a powerful reminder that in finance there is no such thing as a guaranteed return. The words safe and secure can be misleading. Every investment, no matter how it's packaged, carries a degree of risk. Sometimes the biggest risks are hidden in plain sight, wrapped in layers of complex terms and promises of stability. One decision, even one that seems perfectly logical and well-researched at the time, can change everything. Real money has real consequences. It took years for David and his family to recover, both financially and emotionally. The experience forced them to redefine their financial goals and rebuild their trust in each other. It was a long, difficult road. His story is a sobering lesson, a look behind the curtain of financial marketing and into the real-life impact of investment outcomes. If you found this story eye-opening, consider subscribing. We share true money stories to help us all understand the human side of finance. Thanks for watching.